Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the KE Report Weekend Show. Corey Fleck here, along with Shad Marquitz. We are your hosts for this weekend's edition. Please be sure to go back through our website, kereport.com. And podcast, just search the KE Report in your podcast player to listen to all the daily market commentary editorials as well as company interviews. On this weekend show, we're going to be focusing on resource equities and more the sectors, the type of stocks that we think have some of the best upside as we turn the corner into the new year, all focused around portfolio management, having insights from a fund manager as well as one of our more selective newsletter writers when it comes to selecting stocks that he holds in his portfolio. Look, overall this year I think has been good for investors in the resource sector. Yes, a number of juniors have continued to lag, but there's been a lot of outperforming stocks and a lot of doubles and triples throughout this year. To kick off the show, we're chatting with Tavi Costa. Tavi, thank you very much for joining us. Tavi is the partner at Crescat Capital. Crescat is very active in funding a lot of junior exploration companies and providing that liquidity to these companies to get exploring. Tavi, that's where I want to start. Simply the overall market environment for the junior sector. What are you seeing right now? What are you focusing on?
Well, first, thanks for having me. It almost feels like a wave is coming, and we can see it from far away, and it's getting closer. And the money has not trickled down yet to the smaller businesses, but the bigger companies, which their main currency is their share price, is starting to move. And we've seen some of the major companies moving quite significantly in the last 12 months. And I think that eventually will turn into the even more, we've been saying that the M&A cycle has started and we're seeing some M&A activity, but in my view, this is nowhere close to what we're going to see, just given the fact of the depletion of reserves of most of the majors, and their need for replenishing the reserves is going to be into potentially causing a lot of the M&A activity to heat up in a significant way. And so, but the companies are doing better. You can see margins doing much better. I remember back in September 2022, Wall Street Journal put out an article and said, in their front page actually, the gold lost its reserve status. We're about $1,000 higher on gold prices since that the magazine cover curse, and cost has not gone up as much, right? Cost has not gone up $1,000 an ounce to mine. And so most of the companies are actually doing better fundamentally, despite the skepticism. And I would say that with the new leadership politically and other things that are just sort of the nature of the mining industry is likely to be seen as critical again, as a critical industry for the economy. And it'd be surprising if that money doesn't flow into all parts of the overall industry. And so it is exciting. Things are working, but I don't think investors know we're done in terms of not only allocating capital, but looking for opportunities. There's plenty of opportunities out there. And so it's time to be busy.
Well, Tavi, let's dig into that concept a little bit more as far as the opportunities you see. We talked with a lot of companies that said it's honestly easier to go buy a producing asset that is already permitted, that has the sunk cost, even if it's a fixer-upper, than it is to try to go explore, develop, permit, build, get the capital structure together for a mining complex. So is that the environment that you are seeing right now, that it's almost easier to go make an acquisition, and we should see more M&A as a result of that than it is to actually go start a grassroots project and bring it all the way through fruition?
Yeah, I think we have, as a fund, changed the focus on exploration. And I think all that happened for us was that we had a very successful investment that has been transformational for us, which has been the purchase of a producing asset in Bolivia, the seventh largest silver mine in the world, the San Cristobal mine. And so that's an interesting take from what you said. I think our take is slightly different, but I guess what you said applies here too, is more of the fact that you have access to the cash flow of a mine to replenish or actually recapitalize other things that you feel it's important, such as exploration and focus on growth, which is most of the major companies are not really focused on volume. They're really focused on returning capital to shareholders and still very friendly shareholder policies rather than focusing on volume and growth in general. And I think if there was ever a time to be doing that, it's now. And I think it's been also a reflection of what's happening in exploration space as well. Exploration industry is, the big discoveries, the kind of major discoveries we've seen, like Snowline, for instance, they have performed well. We know that the value there has, not to say that it has, in our view, reached its peak of valuation, but certainly has behaved better than other assets. And in exploration segment, you can kind of see that there are some companies that put out, what we call discovery holes, and they put out maybe not three, which is the sort of, rule of thumb. You get three discovery holes, you have a discovery. Well, we have companies that have put out, I guess dozens of results that are supposedly discovery holes and are not really seeing the fruits of that success. And I think that's an opportunity in my opinion. So we've been spending a lot of time trying to sort of clean up the portfolio as much as we can to own most of those companies we think are in that position that have intrinsically improved, but the market is just not caring about that right now. I do think there's some, we've seen some of those things you said about producing assets are slightly easier because they're, having a fixer up sort of approach versus actually taking into production an asset that's still under development and so forth. I can see some of that being a big problem, but there's also a lack of developers in this industry, right? I mean, every exploration company is a seller. In other words, as soon as they get a discovery, they want to sell the company. And there's a gap in the development phase right now. Nobody wants to take those discoveries into production. And the producers don't want to mess with that either. They, as you said, they're trying to buy other producing assets. And so there's sort of a gap in between those. That's going to be an opportunity, my opinion, because there's some great assets there where you can buy lots of gold in the ground and for very cheap valuation. So if you can tackle on a producing asset with that level of opportunity, then it becomes really interesting. And I think there's opportunities like that, in some parts of the world today.
Tavi, I find this very interesting because we definitely have seen a shift of companies, both big and small, focusing on producing assets. With the higher metals price, look, a lot of these assets, almost all these assets, really look like they should make money at these current prices, especially the ones that are built. But what sort of red flags do you look for when you're doing some of this analysis? Because again, these assets that are built, they could have already bankrupted a couple companies, but they look attractive now. So what are some of the red flags that shy you away from some of the assets you've looked at already?
Well, those are good questions. I think most of the red flags from an operational standpoint is, well, I guess they're not crazy red flags. I mean, we've been looking at assets that have some issues with recoveries, issues with, let's say, heap leach operations that we can apply different technologies into. So those have been the main places where we've been and scalable companies. It doesn't need to be massive. I think the key of St. Cristobal was being able to buy an asset that it's very large, but it wasn't big, so big that we couldn't have control over the asset itself. And I think keeping the equity control is absolutely critical. And the only way you can do that is on a profitable mine that is able to sustain some level of leverage. And that's the dance you're kind of playing, right? You're buying an asset that some issues, that the margin is somewhat thin at this point, but there is a potential to change that. And at the same time, you're looking for something that you're just trying to get a structurally right from a equity to debt perspective that then you can restructure at later stages as you improve the business, by deleveraging at later stages and maybe taking it public and so forth. But red flags are plenty. I mean, I think environmental is a big one. And some of those things you end up learning more at deeper stages of the situations. I mean, we've seen failures of heap leach operations recently, and all these things are now in the investor's mind. But, there's a lot more from an environmental standpoint that needs to be, vetted when you're buying those mines. Maybe I would say the employment side is somewhat of a problem sometimes, but not a major issue. I think environmental is probably the top one in mind. We're very much aware of the potential for finding more ore in some of these mines. If we don't have that view, we're probably not going to be interested in getting involved. So I think that's sort of a first box that needs to be checked. But and I think mines today that are being perceived as short-term mine lives and have that potential to be extended, in a multi-year horizon, and at the same time allow you to potentially use that as a balance sheet to do more things is really where the strategy, I think, aligns well in this, rising metal price environment. So I'm not sure if I'm answering fully your question, but there's a lot of typical red flags that I don't want to say here just because I think everybody knows it well, but it really is unique to the asset in a certain way. There's permits that are could be a problem when you're looking at expanding production in different parts of the world, but all those things are very unique to each asset. So we've been in acquisition processes that turn out to be the case that issues are much bigger than we initially thought. And it doesn't mean necessarily that scares us away. I mean, we like buying assets with some level of hair because it decreases competition, but it also increases the complexity of the deal itself, but doesn't scare us away at all. I think it's actually a positive thing in a lot of ways.
Yeah, Tavi, I think some great points there. And I think everybody knows environmental issues are the big one. But like you say, there's other things you look for in a mine that may have hair on it. And when you're seeing other companies making some of these acquisitions, we often see comments from the peanut gallery saying, why did they make this acquisition? Or that's not a great mine. But a lot of times people are looking at things through the lens of the past instead of how it could be optimized, how cost could be reduced, the potential for discovery, like you were mentioning, that you could actually expand the resources. So maybe talk about the green flags, like what you're looking for in an asset that could give it unrealized upside that people are discounting now, but maybe over the fullness of time could be realized.
Yeah, and I think that I personally love to find those boring mining businesses where they have consistently made money in somewhat of a challenging environment. Maybe recoveries have not been as good as they supposed to be, or grades have not been as good as they're supposed to be, and so forth. But they're still profitable. And because they seem to be boring, nobody's interested in them. But if you're of the view that there's a lot more to be found, and assuming there are no, environmental constraints or permitting constraints to expand, this is where opportunities lie ahead. And it seems a lot easier said than done when you're looking for these things, because a lot of times they're really not obvious. And I think all of us fall into that category that you just mentioned of looking at acquisitions and saying, what are they actually thinking? And we just have not done the work to have that view in the first place. And so I think that there's some opportunities today, especially in South America, which has been, now a lot of focus has been turning to Argentina, but in my view, every country in South America today, most of the countries in South America today look very attractive from a value standpoint. And so we've been really focused in that region today because I do think strategically this is going to be a place where capital will flow back into those areas. These are areas that understand mining very well and are much easier to potentially change the landscape when it comes to permitting and how quick you can get something into production, particularly if you're buying something in production that you find an extension of that requires some higher level of development to put that other aspect into production too. So I think that South America is certainly a big focus of at least mine at this stage. Some of those, I guess, green flags is always important to find company. Well, we've had two situations. We're looking at a mine, for instance, with an incredible team, right? That was in Cristobal, incredible team put in place, and much easier to kind of do a management led by of the company and sort of allow the existing management and kind of align them accordingly to perform well and have a significant ownership of the mine. But there are other assets where it can be quite tricky. The main reason why the mine is not doing well is because of the actual management. And so you have to make a major transition of the personnel, and that can be and culture and all sorts of things, and that can be somewhat tricky. But that's a lot of times this is where opportunities also lie ahead, and where we like to focus on. And it's really looking at stress testing what is perceived as hair is absolutely critical as an investor in anything you do, because that's usually where the opportunity is. And so there's no formula to these things, and it's not an exact science, or it's more of an art. And so, and every person will have their own strengths in terms of pursuing these ideas.
So, Tavi, San Cristobal, that's a silver mine. You said you're still looking in South America. Are you seeing more opportunities in silver mines, gold mines, or are you going to go into the base metals? A lot of people have been focused on copper, but those are much larger assets. So, which metals are you focused on for acquiring?
We're very metal agnostic, but I guess copper has been certainly a big focus. Gold mines, I think, not too long ago, and you can see this in public markets too. If you look at copper mines versus gold mines or miners in terms of ETFs, you can see easily the relative performance of copper miners have been quite, I guess, significantly better than gold miners, despite the fact that gold has outperformed copper quite significantly as well. And that has mostly to do with institutional capital chasing these things. And so we started looking a little further into gold assets in a big way, because the fact that you don't have the same level of institutional capital chasing these copper assets, it makes it more inefficient, and so you can find some better opportunities. Silver assets are difficult to find, but it's still number one focus if there is one. It's always harder to find. Zinc mines and lead are certainly part of our focus too, and very open-minded to those, especially as they continue to be perceived as critical metals as we move forward. But again, I think being open-minded and sort of metal agnostic, because while everybody likes to have specific views on specific metals, once gold gets into a secular change, it tends to drive all sorts of things a long way. And copper tends to move alongside. Yes, it's more cyclical, but if gold goes up, usually copper goes up as well. Silver does the same thing. We know of the gold to silver ratio. All of us follow that closely. And when silver really starts going, all of us know that there's a lot of leverage in silver prices. Therefore, why I like to focus on that too. But that's not just the case. If you look at zinc prices over 100 years of price history, you'll find that it's in a massive upward channel. And so I see no issues also buying a mine with that type of exposure. So there's very openness, and I would love to be somewhat open-minded to lithium. It's definitely not our expertise, and we don't know much about that market. But given the fact that it's gone down so much, and understanding the dynamics of rotations of how commodities work, I mean, when you're in a commodities bull market, it doesn't mean things go up forever. I mean, they kind of rotate from one to another, and that's basically what we're seeing. And now lithium is out of flavor, but it will probably come back in favor again and at some point. And so I'm open-minded to that as well. I wasn't as open-minded before, but certainly now it's something I'm more and more curious about. And it's not an expertise of Crescat or group that looks to acquire these things, but certainly is when prices come down as much as they did, I think it becomes an opportunity as well.
Well, Tavi, just tying this all together, when you're looking at making acquisitions in the space, whether it's exploration, development, or production assets, we've talked about red flags, we've talked about green flags, we've talked about the metals, even got into the jurisdiction a little bit. I guess just tie it all together for us as far as seeking value creation cyclically within a cyclical cycle. Like there's times to buy and there's times to sell. There's times to make acquisitions and there's times to make hay while the sun's shining. What kind of time period are we in? How much longer will this acquisition window be open? And at what point would you not be interested in acquisitions where you just want to develop the assets you have?
Well, there's a secular change itself, and there's also ups and downs and different types of things you should do during that secular change. I think first thing you need to do is and have a view about that. Is are we in a long-term upward movement for gold prices? That's the metal you need to focus the most. If you are of the view, the central banks will continue to buy gold and have to also, really enhance the quality of their international reserves and pushing the metal price higher, then you are also of the view that silver, copper, zinc, all sorts of things are going to do well as well. Now, this is a long-term thing. There were times in the 70s where miners were down 70%. Are you ready for that? And that's, those are going to be great opportunities. You're going to be tested along the way, and there are going to be times where the acquisition window opens and the acquisition window closes. Right now, it's open and it's very difficult. There's a lot of competition. There's definitely plenty capital chasing these opportunities right now. Funny enough, they're not happening in the exploration space. None of the capital is going there right now. And oftentimes that's where the opportunity lies ahead. But in my view, so the acquisition window for the exploration space is just getting open now because that capital ultimately will, if we look at the acquisitions we've seen so far, in the context of the market, in the context of history, they're not frothy, but in the context of where we are in the market and where valuations are of the whole industry, some of them are somewhat frothy. But that, if people are willing to pay that in those parts of the producing assets and so forth, at some point that capital starts chasing other opportunities that are cheaper. At some point, they end up finding out that exploration and some development names are extremely cheap and should be part of the opportunity. So, my view is that you have to keep yourself grounded on the secular opportunity, but also be open-minded of the cyclicality of that as well, of which being able to step in when the timing is right. And so, for instance, gold prices go down 20-30%. I would welcome that. I hope that happens personally. No, because I think that would be great. I think that window of opportunity would open again for acquisitions of producing assets. A lot of the producing assets being sold and folks looking to sell those assets are going to be under pressure. And so I'm looking forward to those times as well. And they're going to come. They're going to happen again because they always happen. And so, it's just, I guess, learning history as much as you can so you can be ready for those opportunities, understanding that they will come and that things transition. They're not always the same way. 5 years from now, exploration can be, the top performing segment of the industry. And would that surprise you? It wouldn't surprise me. And so, we're going to see those changes within the industry as part of this secular, movement in the gold prices alone. And so, and we're going to go from one metal to another as well. This is just part of the game. Not too long ago, everybody was, basically pounding the table on copper, and then gold had to move. It's so classic. It's all these changes are normal. And, I think we just cannot overthink about these things. I mean, this is, to me, is the best opportunity I've seen in my career for those thinking, oh, the juniors are not moving. What's going on? Emerging markets are not moving either. Look at the prices of Brazilian banks that have nothing to do with that. And that's because the money has not trickled down from gold specifically into the other things that usually move along with gold. Emerging markets, other metals, and the juniors. And that money eventually goes there. It's because all the money is being sucked into the dollar and equity markets in the US, which most of these go into technologies. But we all know these types of leaderships, they change over time as well. And, in my view, that the transition back to the rest of the world is very likely to happen. And it's probably going to be one of the biggest transitions we're going to see throughout history.
We'll see when that happens. Hey, Tavi, I know a lot of the metals investors are still waiting for that transition, but again, it has been a good year for the metals sector, especially for precious metals and a number of the stocks. Just interesting to hear that even you guys over at Crescat are looking for more of these production assets to acquire. It seems like that's the trend. A lot of companies out there looking for production assets to generate some cash flow so they don't just need to keep going back to the market. Again, Tavi Costa, partner at Crescat Capital. I'll post the link to the Crescat Capital website in the show notes. Tavi, thanks for joining us, and everyone, stick around. We're going to be right back to continue talking about portfolio management in the resource sector.
Al Corlin's firm, AB Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. We are now chatting with Brian Leni, founder and editor of the Junior Stock Review, and it's time to dive a bit more into individual companies and some individual stories from the resource sector. and a recent trip that Brien was just on to Japan, a site visit to Irving Resources. So we're going to be recapping Irving Resources, also talking about Montague Gold taking a stake in Sanu Gold, that is an exploration company, as well as FPX Nickel announcing a share buyback. So Brien, let's start off with your recent visit to Japan. Irving Resources traded on the CSE under the symbol IRV. It's focused in Japan. It has a portfolio of projects, and it has slowly been exploring these projects. There seems to be some positive recent news out with some joint ventures with major miners. However, look, the stock price continues to be under pressure, and as we're recording this, I believe it's trading at all-time lows. So, Brien, give us your narrative, your analysis on Irving Resources, please.
Oh, thanks for having me, guys. Yeah, so it was a great week in Japan, especially to see Irving, a company I've been invested in for the better part of 5 years now. And it's been a real roller coaster, as you alluded to, Corey. The share price is at all-time lows. And I think the market is really missing the value in the company and maybe even the potential upside in the projects that they have. I'll start with Omu. That's what most people, if they've heard about Irving, that's what they're probably familiar with. In the north, it's on the island of Hokkaido. And basically the drilling that they did there never uncovered the higher grade gold and silver mineralization that they were looking for. And so they kind of put a cap on that after hitting around 20,000 meters. And just recently announced a joint venture with JX Mining, which is Japan's largest mining company. And JX is interested in using the silica found in the sinter, I guess the sinter cap of the low sulfidation system, for their smelters. And this is important for their smelting process. And the flux acts as not only like it prevents heat loss, but helps in the whole smelting process. So to me, that looks like a pretty good slam dunk to be a mine in the next couple of years. They're going to be doing some other drilling, of course, do the studies that need to do to get up to the time where this is going to become a mine and go through that process. The upside potential in that is if they hit any higher grade mineralization. They really haven't done a lot of deep holes at the center. And if you look at the agreement, the stuff that JX is going to have ownership over is, I believe, only 50 or 60 meters deep. So anything deeper that they find is basically a new negotiation between the two companies, and because it is Irving's. So I see there's definitely potential there, but that's its own thing. What I really think investors need to look at right now is Yamagano, which is in the South Island of Kyushu. It's about an hour's drive from the airport in Kagoshima. Really interesting place, total contrast to the north, hot and humid. Tons of red cedars and mountainous in terms of setting. The significance of Yamagano is that it's about 14 kilometers south of Hishikari. For those that don't know, Hishikari is the highest grade gold mine in the world currently. It's owned by Sumitomo, has a head grade around 30 grams per ton. And these guys, this is not a 24/7 operation. These guys essentially mine a few 100,000 ounces of gold per year and then basically shut it down. And that's been going on for, I think, since the late 80s. And so Yamagano is to the south. It's the same rocks, a little bit different age of systems here from what the geologist told us on the site visit. But the footprint and, again, the geology are very similar. And Yamagano is interesting. It's basically split into two different sections. You have East Yamagano, where they're doing the drilling right now, and West Yamagano, which is where the historical workings are. And it's the portion of the project which was optioned from the Shimazu family in Japan, which has a long history of mining there, but also of being basically royalty amongst the Japanese. And if you do any research on it, you'll see quite quickly how respected the Shimazu family is. So they've chosen to look at the East Yamagano first. It's where the prospecting license is. And it's where, if you look at the geophysical anomaly, it looks like the down dip extension of the historical workings at surface. And it's just so eerily similar to what you see at Hishikari. And they're doing 700 to 1,000 meter holes right now. They just finished hole number 2 while we were there, or just before we were there, and are currently on hole number 3, which is scheduled to be done by the end of the year, with hole 4 and 5 to be done in Q1. So hole number 2 results are upcoming anytime this month. And then, of course, you've got 3 more holes at the end of the year. And I would say, just judging by the talk around it, these holes are designed to take a look at the structures. If they hit mineralization or high grade mineralization, that would be fantastic. But these are as much about exploring what is there, because it's fairly deep and it's the down dip extension. And this is how Newmont wants to conduct it. So I think there's a lot of catalysts ahead. And of course, the upside potential when you compare it to something like Hishikari, the potential is definitely there. And that's why you have the largest gold miner in the world going after it. They don't go after small targets. And so that's how I look at the company right now. And considering it's trading at its all-time lows, I think for anybody with some speculative money that wants to play exploration, but in a project generator type of model where the risk to the junior is that much less, I think Irving's got to be near the top of your list.
Well, Brian, just following up on that very last point you made, that Sumitomo is not in this to go after small. They go big, and same thing with Newmont as a JV partner. And so with both of them in there as key strategic stakeholders, I mean, they just put out some news on October 17th that I think Newmont has 60%, Irving has 27.5%, and then Sumitomo has 12.5%. But you also have people like our friend of the show, Giant Bandari, that was down on the site visit at the same time and reported back on excitement around this. You have Quentin Henning, one of the most preeminent geologists, very excited about it. So you have majors excited. You have people that understand the resource space, yourself included, that are excited. Yet the stock price at an all-time low. What is the retail market missing here?
I think people, past they think is prologue. COVID really smashed the news flow for Irving, where, things completely slowed down. The Canadian drill crew that was there, that was originally drilling Omu, was basically shut out of the country. And this was kind of the story across the world. But of course, Japan, I think there was almost an extra layer there, just as it is. The bureaucracy and the approvals that need to be run are much slower than, let's say, Canada or maybe the US in some circumstances. So with the results not necessarily being there for Omu, and then the fact that news flow was slowed right down, I think people got bored and they left. And new people to the story, again, I don't think have had a steady flow of news to get excited about. But I think that's going to change. Again, the potential I see in Yamagano, I think, is what's being missed. And maybe it does need a few news releases to get out there for people to catch their attention. But for those people that were looking at Irving before, I think it is boredom / they're saying this is what's going to be projected forward. And I disagree. I think that things are starting to ramp back up. These drill crews that were trained in COVID or just post-COVID to do the drilling, Japanese run and led and operated, are starting to hit their stride. And so I think, we're well on the way towards steadier news flow and getting the story back out to the market. So in essence, this is almost like a reboot for Irving coming up, and hopefully on the back of some good results.
Well, let's face it, Brian, this company needs some good drill results, and I think they also need to raise some money too. Their last financing, they raised just over $1 million back in June. If they want to really move this joint venture forward, fund the exploration that's needed to hopefully generate some of those drill results, well, they need funding and they need good drill results. There's no denying that, is there?
No, not at all. Not at all. And really, I guess those drill results are what pushes everything. You can be, I think, a little bit lackadaisical on the marketing side if your results are good. And that's the baseline for everything. So yeah, and you're very correct that a financing probably has to come in the first part of next year. The other side to it is the way that the agreement is set up, that, I believe they could just get further diluted, which isn't necessarily the answer. But what I'm saying is Newmont's the one that really, Newmont Sumitomo are going to push this thing. They're the biggest portion of the project. If they want to spend the money, they will spend it, and Irving has the choice to raise the money or get diluted. So I would say, yes, I would guess that they will probably raise money in the first half of next year, but I'm not necessarily sure but I think they're in a good position considering the potential and, what might be ahead for these results. Again, if they're really good, then it will be that much easier to raise the money.
Well, we'll keep following along with it, and hopefully Irving has some good news flow out, and hopefully hole number 2 comes out with a big win for the company, something we'll definitely keep following along with here at the KE Report. But Brian, we were having an interesting discussion off mic about junior companies having, being on the treadmill of raising funds and trying to build value, but deciding to deploy it in interesting ways. And two of the companies that have recent news out that we alluded to at the onset is that FPX Nickel is going to be using about $1 million to buy back some of their own shares. And then you also have Montague Gold decided to take a 20% stake in Sanu Gold and spending about 5.5 million Canadian on that. It's an interesting proposition to see, pre-revenue companies taking cherished capital and not putting it in the ground, but actually doing other things with it, buying back shares or taking a strategic stake. What do you make of that process, and how has that historically worked out for junior mining stocks?
Yeah, it's an interesting topic. It's one that I view with a huge amount of skepticism, especially the junior taking an investment in another junior. I think I'm probably most skeptical of that. When capital, especially over the last couple of years, has been so hard to raise, when a junior makes the decision that the money is better spent or invested or speculated, however you'd like to look at it, into another junior instead of their own project and their own business, it really sends me for a loop. I don't recall it ever really working out. There may be some examples out there that people can remember, but in my experience, it hasn't worked out. So Montage's deal, mind you, the Lundins have such a good track record, but I'm not sure who's driving that, whether that's driven by the Lundins and it's, we should involve Montage in this, or if it's the other way around. But again, I view it with a lot of skepticism, especially when you get up into those like $5-6 million types of investments. That's a big deal, and we'll see how that plays out. On FPX's side of things, it's to a much lesser scale. They can, if they choose to, like you mentioned, spend up to $1 million in buying back shares. They've got a really strong treasury and 30+ million. So I understand Martin's and the board of directors rationale to say, okay, maybe this is a good time to buy back shares. End of the year, FPX has had a tough year in terms of performance on the back of that First Nations issue last August. And, maybe this is much as about protecting that downside in the share price as it is to just put it out there to say that, hey, look, we do have the money if we want to do this, and we can buy back these shares, and it's a good investment. But it's still, the overarching thought is, it's still a junior company saying that the money is better spent, buying back shares than it is going into the ground or doing a technical study or doing this or that. So again, I view these things with skepticism. To me, FPX, I've been a long-time investor, and I respect Martin and his board to the utmost. And so I'm not overly concerned with FPX. But the Montage deal in Sanu definitely gives me pause, because I can't recall it working out in the past where you've had these sorts of arrangements.
Look, FPX, I feel like this whole share buyback is really just about reminding everybody just how much money they have on the balance sheet. It's something that I chatted with Martin Turin recently about through an interview on our show. This Montage investment, though, let's dive into that a little bit more, because look, Montage, they're investing $5.5 million. They get almost a 20% ownership stake, and then they get to join Anglo Gold, that also has about a 14% stake, I believe, and then the Lundin family, it has a 10% stake. We need to understand Montage has over a $700 million market cap, so this isn't a huge investment for the company. Do you just think that this is more relationship based, though? Joining with Anglo, joining with the Lundin family, and really not having to focus on that exploration side of things, just being able to ride along with this investment?
Yeah, it very well could be. And honestly, I don't necessarily view it negatively. It's just the whole topic of what it sort of says that is interesting to me. And it's as much a thought exercise for myself into how these things work. But you could very well be right. It could be relationship based. It could be that they know or someone knows the geology well enough that this microcap is worth putting the money into, and maybe in the long run the $5.5 million doesn't matter. It probably doesn't. It's still an interesting thing for a company that doesn't have any revenue to investing in another, penny dreadful that, just so many times I've seen these things not work. And especially when you talk about West Africa, depending where you are, these guys are in Guinea, there's definite risk there, no matter who's managing or who's involved. But you're right, in the whole scheme of things, it's a small amount of money for a company that's got access to hundreds of millions. But for investors, I think the more important thing is to think about the concept. And when you see it happen around the sector, not necessarily with those sort of crown jewel companies or groups like the Lundins, the Montague Golds of the world, to take pause and to think about what that means with respect to their own investment, and make sure it's the right thing that the company should be doing.
Well, and just digging in on the concept even further, I guess it also comes back to all the times these companies, and not just these two, just any junior company has to do a raise, the investors that are behind that company maybe have a voice in how that money is spent. But in general, people are putting money into companies because they want to see the projects, developed and moved forward. They're not typically investing in Montage so that they can take a position in a company in Guinea, unless maybe they're going to try to take the company over at one point, or like you're saying, work on these partnerships. And even the share buyback idea, if you've got 30 million, sure, you can spend the million to do it, but you had to raise all that 30 million at one point, and those people wanted to see it go on the ground. So in general, I think that when you're looking at junior companies, how much money out of a capital raise should go into the ground? How much of it should go to G&A? Do you have any things that you look for as red flags or green flags?
Yeah, I don't have exact percentages when it comes down to how much should go in the ground versus G&A. Obviously, I'd like to see the G&A as low as possible, but there's that obvious connection to people that have had success, especially in the junior resource sector, seemingly always get paid for that. And so for the most part, I accept that to a degree. So I don't have a hard, fast number in terms of percentage. I think you can sort of tell when you see how a company, you can go look at the balance sheet, the financials, and you can see how they're spending the money and how and then you take a look at who it is that you're dealing with. And you can sort of get a sense about how that money is being spent and how out in the open it is. I think there's a lot of companies that do much shadier things, and you see contracts with numbered companies and arm's length deals with companies that are owned by management or a board of the director. Like, there's certain things that sort of tip you off to how that money is being spent. And although let's say the G&A is within 20 or 10 to 20%, which may be the top end of G&A spend versus what goes in the ground, you have a lot of question marks because of who they are and where the money is going. So, each of these situations is so different. And I don't necessarily think there's a rule of thumb, but generally you want to see as much going into the ground as possible, especially when you're talking about micro cap companies under $50 million market caps have to be putting, 90% at least of the money going into the ground. You can't, I've seen enough companies where you've got a $10 million market cap and the management's taking $1 million in salary, and you think, where's the priority in this company? Well, you know where it is, and who knows how else in the financials things are hidden. So it's probably well over that $1 million that they're actually taking in. And so they're much more interested in mining the financial market than they are in ever creating or discovering a mine. So it's going to be up to that investor to look at each situation probably a little bit differently, but just know that those big names in the sector are going to come with bigger price tags. And I think for the most part, they're worth it, but it's going to be up to that individual investor to sort of where that line is and how opaque or clear the situation is with these individual junior mining company. But it's certainly a great topic to cover because not enough people look at financials. They look at how many ounces are in the ground and sort of the superficial stuff, and don't necessarily look or judge management by how they have the financials set.
So true, Brian. I love looking at financials, and they're pretty easy to go through when you're looking at an exploration company because it really is just all expenses. So see how that's being allocated, and also look at those management information circulars where you can then see how much management is getting paid and how many shares and options they hold to see just how incentivized they are with shareholders. Brian, this brings up a bigger topic then in terms of portfolio management as we transition into a new year. Look, 2024, if you are in a whole lot of sectors, but we're talking metal sectors, in precious metals, in uranium stocks, there have been some very good opportunities. And quite frankly, your portfolio should be up a little bit as long as you didn't chase some of these when the sector was really moving. That being said, I know you have a much more concentrated portfolio. What do you do as we turn the corner into the new year? Do you trim some winners? Do you load up on those winners? How do you at all just analyze your portfolio for that new year transition?
That's a good question. Again, I don't think I necessarily have any percentages of my portfolio in any one certain type of company or jurisdiction or anything like that. I think the baseline for myself is I first understand where my strength is, and it's with companies with a resource or some sort of technical study that I can kind of dive into. On the exploration side, I again know myself. I know that I've lost, or I have definitely lost money on solo explorers in the past. And not only that, but the risk of dilution is so high. No matter if the guys are basically successful or not, it's just the degree of dilution that you're going to be, or you're going to accept. And if the stock's going up, obviously that's easier to do. But for me, I want to be in project generators. That's basically how my portfolio is set up, is the mix between project generation on the exploration side, developers sort of in the middle. And then I've got, G Mining at the top end that is a producer now, but their development side is, again, I think somewhere where my knowledge can help me get a step up on the market. So it's basically split up amongst those and where I see the opportunity. On the exploration side or project generation, not all those companies are created equal. And I find companies, and I'm a shareholder and I've covered Kenorland in my portfolio for a long time. I've been buying Kenorland stock a lot, and it represents a huge percentage of my portfolio. And it's for good reason. I really believe in management. I believe in the business model they have. And I think this is just the tip of the iceberg, especially when you consider how much cash these guys have. It gives them so much leverage to execute on projects like South Uchi and get arguably the best deal a project generator could want on optioning a resource project. So on the developer side, like you said, it's taking profits, it's moving them into other companies that I see that are selling for less than they're worth, and not getting too caught up into the blue sky potential, gold to 10,000 type of mentalities, is hitting my price targets, taking some money or closing positions and moving on to the next thing. But you know what, like I said, how I started this off, it all starts with that individual investor first. You have to understand where your strengths are, where you want to invest, what your risk tolerance is. And then you sort of start balancing money through there and buy projects or companies based on their underlying value, not necessarily because gold's going to $5,000 or silver's going to $100. I think this is where people can get sort of lost and stick to those best of best companies, or as best as you can analyze yourself.
And I think those ones have been the ones that have performed better this year as well, even some of the smaller ones, where the smaller stocks have broadly lagged the larger miners, even the mid-tiers. And one other note, hey, I had an interview with Kennerland Minerals also this week, so everyone go back through the website or podcast, listen to some of our daily editorials and company updates from throughout the week. Brian, it's great having you on the show. Everyone, thanks for tuning in to this weekend show. We will be back with you next week. I hope you all enjoyed this weekend show. Have a great rest of your weekend.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.